Every day, countless decisions shape the future of businesses worldwide. But what drives these decisions? The answer lies in one powerful tool: accounting information. From investors seeking profitable ventures, managers within organizations needing detailed accounting data for strategic planning, business owners depending on accounting information to monitor performance and ensure sustainable growth, to government agencies ensuring compliance. Accounting information serves as the backbone of informed decision making. Welcome to Concierge CPA. I am Juliette. In my previous videos, we have been learning about basic and fundamental accounting topics such as debits and credits, the accounting equation, what are assets, liabilities, equity, how information flows within the accounting system, the basic financial statements. But in this video, we're going to talk about the data that feeds all of those accounting concepts. If you ever wonder what really is accounting data and why it's valuable, well, today I will show you how accounting is not just about crunching numbers, but about creating a resource to help move businesses forward. It all starts with data, information. But in order for information to be useful, it must possess certain qualitative characteristics. These qualitative characteristics of useful accounting information are identified and defined in both the FASB's and IFRS's Conceptual Framework of Accounting and Financial Reporting. Qualitative characteristics are attributes that enhance the usefulness of financial information. Under the Conceptual Framework for Financial Reporting, these characteristics are classified into two main categories: fundamental and enhancing. Fundamental characteristics directly impact the decision-making process. These characteristics must be present for the information to be useful in decision-making, while enhancing qualitative characteristics improve the usefulness of the information provided. Let's start with the fundamental qualitative characteristics. There are two: relevance and faithful representation. Relevance. What does it mean to be relevant? Relevance refers to the ability of information to influence decision-making processes. For financial information to be relevant, it must have the capacity to make a difference in the decisions made by its users. A key aspect of relevance is its predictive and confirmatory value. Let's define these two components of relevance. Predictive value. Financial information has predictive value if it can be used as an input to processes used by users to predict future outcomes. This means that even if the information itself isn't a direct forecast, it can still aid users in making their own predictions. For instance, current financial data can help stakeholders project future performance by analyzing trends and patterns. Confirmatory value. This refers to the ability of information to confirm or correct prior expectations. Financial information holds confirmatory value when it offers feedback that either validates or revises prior assessments. Predictive and confirmatory values are interconnected. Data useful for forecasting future outcomes often also serves to affirm or adjust past predictions. For instance, analyzing current year's revenue can aid in forecasting future revenues, and when compared to past revenue forecasts, can help refine the accuracy of those earlier predictions. The second fundamental qualitative characteristic of useful accounting information is faithful representation. In other words, reliable accounting information. Faithful representation refers to the accuracy and completeness of the financial information reported. For information to be faithfully represented, it must have the following three characteristics: be complete, neutral, and free from error. This means that the reported figures must reflect the economic reality of transactions and events without bias or omission. Let's break this down a bit further. For accounting information to possess representational faithfulness, it must be complete. To be complete, information must present a full picture, including all necessary data relevant to the financial status of the entity. A complete depiction includes all information necessary for a user to understand the economic reality being depicted, including all necessary descriptions and explanations. 2. It must also be neutral. The information must be free from bias, offering an impartial representation of the facts. And 3. It must be free from error. Faithful representation does not mean accurate in all respects. Free from error means there are no errors or omissions in the description of the financial data presented, and that the processes used to produce the reported information has been selected and applied with no errors in the process. While perfect accuracy may not always be possible due to estimates and judgments involved in accounting, the information should be free from significant errors that could mislead decision makers. So to recap, relevant information helps stakeholders make well-informed decisions from investment strategies to credit evaluations. Representational faithfulness ensures that the stakeholders can trust the financial information presented to them. In addition to the two fundamental qualitative characteristics of relevance and faithfulness that we just discussed, there are 4 enhancing characteristics that improve the usefulness of financial information. These are comparability, verifiability, timeliness, and understandability. Let's take a look at each. Number 1, comparability. Comparability allows users to identify similarities and differences between financial statements of different entities or across different time periods. This characteristic aids in making informed decisions by providing a basis for comparison. Comparability is achieved by applying and disclosing the accounting standards used consistently from one accounting period to another. Also, by disclosing the accounting standards used, users of the financial reports can compare data across entities and be aware of the accounting standards applied to calculate the financial data presented. Number 2, verifiability. Verifiability means that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. One example of indirect verification is if independent users are given the cost of equipment, the useful life, salvage value, and depreciation method used, they should be able to reproduce the same results. This adds to the credibility of the financial statements and enhances user confidence in the data. Direct verification is achieved through independent auditors, where they have direct access to the supporting documentation for the reported information. Auditors play a crucial role in verifiability. Number 3, timeliness. Timeliness emphasizes the importance of providing information promptly. Delayed information can diminish its relevance, as timely data is essential for making informed decisions in a fast-paced financial environment. And number 4, understandability. Understandability refers to the clarity of financial information. It should be presented in a manner that is accessible and comprehensible to users, allowing them to grasp the significance of the data without undue complexity. Here is something key to understand. Enhancing qualitative characteristics should be maximized to the extent possible. However, the enhancing qualitative characteristics, either individually or as a group, cannot make information useful if that information is irrelevant or not faithfully represented. And that is all for today. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights into the world of business and finance. Thank you for watching. See you in the next one.